Hi, in this video I'm going to talk about the different types of return there can be as an investor when you own a share generally in a business. As you can see here, we're going to first talk about dividends and distributions, which is the first type of return, and that's in regards to companies and funds. Then the second type, which is capital growth, and again, companies and funds. And then we'll go to talk a bit about property and how you can use those concepts of capital growth and dividends to understand better the property market. So to start off with, dividends in companies. So a dividend or a distribution, they're synonymous, is when a company pays part of its profit or all of its profit to its shareholders. So you can imagine as an owner of a business, you make a profit and you pay yourself a certain amount of money. It can be all of that as the owner of the business you receive, or it can be some of it, or it can be none. You could choose to put all that money straight back into the business. So if you own a bicycle company, instead of paying yourself out all the profits you make from selling bikes, you use it all to buy new bikes to sell them out again. But you're pumping money back in at the hope that one day you'll be able to pay yourself even more money as the owner. So companies do that for shareholders, and they make that decision themselves on behalf of shareholders. So if you own a share in a company, you're entitled to share in their profits if that company has decided to pay you those profits, as opposed to reinvesting it to grow more. So usually bigger companies and older companies pay more in dividends or distributions because they have less room to grow. They don't have to go out and, in that example, buy more bikes. They've bought all the bikes they need and they don't have that much more of the market to grow in. So instead, all the money they make, or a lot of it, they pay back to shareholders. So an example is Unilever, one of the biggest companies in the Netherlands, and they have a wide market. They can't grow that much because they're already so big in it. So as you can see here, the company stock hasn't grown that much. It was near 40 just 5 years ago, and it's 46 today. But what they have done, and I've circled it or put a square around it in blue, is paid a dividend, and that's called a dividend yield, and that is 3.4% in this case. And that means for every share you own, for every €1 of shares you own, or let's say every 100 euros of shares you own, they will pay you €3.40, and that's the kind of return you get on one share. So you'll, as I said, by owning 100 shares worth in Unilever stock, they will pay you generally about €3.40, and that comes from their profits. Those are the dividends. So you invest in that to get it, essentially a 3.4% return. Each year they pay you out those dividends. The profits won't change that much because they're already so big. Then the second example of dividends is investing in a fund. And here I've chosen a random example, which is a fund called Robeco. It's a Dutch fund manager, and they put together funds where they buy on behalf of individuals like yourself. So instead of you having to go and find Unilever and find companies with high dividend yields or high returns, this company will do it for you. And as it says here, they invest in the United States in companies that pay high dividends, because not all companies, as I said, will be paying out their profits to shareholders. So these guys here, they show you they've done 3.4% a year, and that's pretty similar to what Unilever was doing. In fact, pretty much the exact same. So that gives you an example of the kind of average dividend return you might get at the moment. So it's not enormously high, and the reason really is because it's less risky investing in these enormous companies that their profits are quite set in stone. You know that they'll probably be able to keep on generating profits. So there's a high demand to be buying these companies. And that's dividends and distributions for companies and funds. And we'll now go into capital growth, which is another way as an owner that you can get a share and increase the value of owning something. And in this example, I'm showing you a company, another Dutch company called Adyen. And this is an organization that if you don't know, they do payment processing for other companies like Uber, for instance, so that when you're buying online, paying for your taxi, it goes through Adyen. And they are what's called a growth company, so they are trying to get as big as they can and dominate the market and be the biggest payments provider out there. So they're not actually paying any of their profits to shareholders. And you can see at the bottom right, the dividend has just got a dash next to it because they're not paying anything, unlike Unilever, which was paying out their profits and had a 3.4% dividend yield. But on the other hand, it's still worth being a shareholder because, as you can see in Adyen, whilst they haven't paid any of their profits to shareholders, they've kept investing their profits back into the company to grow and grow, and that's reflected in the share price going up. And it's gone from 400 when they first became a company that you could buy shares in 2018 to now being 1,200. So it's actually gone up by 3 times. It's an enormous return. But again, shareholders haven't seen any money. And the reason is because they've kept on growing. The idea is that one day, the amount of dividends they will be able to pay, the profit they can share with shareholders, has just got bigger and bigger over that period of time. And that's the reason to be investing in it. And you can buy your share and sell it in, 2-3 years' time, and hopefully sell it for more because the company's profits more, even though they haven't given you any of their earnings as a dividend over that time. Then, just like with the distributions and the dividends, you can get a fund to do it for you if you don't feel confident choosing a company like Adyen, because you might choose one that's not paying any dividends, but instead goes from 400 euros to €0 because it loses all of its market share. So you get a fund, a professional, to do this for you. And they have loads of people's money like your own, and they're looking for companies like Adyen to invest money in. And I've chosen the example here randomly of ASN, a Dutch bank that creates funds for people to invest in to find a group of companies like Adyen that will make a good return. But ASN's focus is a bit more on ethical, specifically companies. And in this case, this ASN fund has made a pretty good return. They've gone from being the equivalent of 100 euros 10 years ago to 210 euros now. So you've more than doubled your money in those 10 years if you put it in, because they found a lot of companies, maybe some like Adyen, but as you can see, the return hasn't been as high as going up 3 times in Adyen in just 2 years. And the reason is because they've got a portfolio of stocks, so some will do well, some will do badly, but they're focusing on your behalf on growth companies. Now, I'll apply these principles to the property market. And the first way we start off with is the rental yield, it's called. And it's a bit like a dividend, and the term dividend yield came in. And the rental yield, like a dividend yield, is simply the amount of or euros they pay you per share that you own in a company. So it's how much money every year, how much profit a year you get from having to buy this share in a company. The same goes for property. So it's the amount of money you get every year divided by the price you have to pay to buy the property. That's what a rental yield is. So the 2 good examples are Amsterdam and The Hague. So every city generally has its own what's called a property yield, and that is the average return you get on a yearly basis, the average amount of rent as a landlord you receive, divided by the average price of the property. So, for example, in Amsterdam it's 4 to 5%, which means if you buy a property worth 100,000, you could expect to receive 4,000 to 5,000 euros per year in rent. And in The Hague it's slightly higher, it's 6%, which means if you buy a property for 100,000, you could expect 6,000 per year. So those are pretty good returns, and you might be wondering, well, why is Amsterdam lower than The Hague? You might think, well, it'd be higher because, well, Amsterdam is a more desirable place to live, potentially. Depends who you ask. And the reason for that is, of course, every year, as I say, the rent is being paid to you. So the higher the price of the house, then the lower the yield's going to be, because you're paying a lot for the house, but you're probably getting a bit less for rent. And in Amsterdam, the idea is that property prices will keep going up, and they have gone up tremendously, and you can see that in this chart. That's the lightest blue line. They've far gone up higher than The Hague, Rotterdam or Utrecht, and in fact they've gone up by almost 4 times in the last 20 years, the property prices. So you have to keep paying more and more for property, and therefore if you own a 1-bedroom house in Amsterdam, it's going to cost you probably quite a lot, but you can only still rent a 1-bedroom property out for a certain amount, whereas in The Hague it's going to cost you less for that 1-bedroom house, but you can rent it out for probably the same amount as you can in Amsterdam. So the yield in The Hague is higher. To make that more clear, the 1-bedroom house costs you 100,000 in The Hague and you get 6,000 a year for that, but the same property in Amsterdam will cost you a little more, but you'll probably still get the same rent from that, and that's why the yield is lower in Amsterdam. So thanks very much for listening, and I look forward to seeing you in the next video.